Hi everybody, Matt and Paul here again, and today we're talking about those who are considering moving back to the UK from Gibraltar. Now we called this a complete financial and tax guide for UK expats returning back to the UK, but time is limited and I don't think we can really offer that scope of information today. So Paul, I think we're going to cover the highlights. So you have an individual, they've been living in Gibraltar. I think they must have lost their mind because they're returning back to the UK. But what sort of planning do they need to do?
Well, I mean, there's a certain element of emotional, there's an emotional element, and the financial reality of returning home, and how that impacts your net worth. So, there'll come a point where you decide in your mind, now is the right time to return. And it is at that point in time when you have to consider how to restructure your financial affairs to make them UK tax efficient. It's not that, you go through that discussion with your spouse or whoever, and you arrive at the decision that you're returning back, and then just pack your bags and then you land, and then you start thinking, oh, how is this going to affect me tax-wise, what are the financial implications? So the moment you make a decision to leave, and probably would coincide with the end of the UK tax year, so it's a clean, you start with a clean year in the UK, although you can leave earlier if the number of days that you spend is from a statutory residency, UK statutory residency test perspective, is below the threshold, so it doesn't trigger residency. In other words, Matt, you leave for the UK back on the 1st of January 2027, and even though you spend 3 months and a week in the UK, that's not enough to trigger residency because of the number of ties. So it doesn't really matter. You've arrived in the tax year 25-26, I think it is, or 26-27, but you haven't really triggered tax residency. That can happen, or you do it a clean year and you arrive on the 6th of April. Whichever works, but you have to consider, if you don't do a clean year, then that when you arrive, it would never trigger residency the year you've arrived, yeah? Because you don't do enough days in the UK. So, I mean, that's the starting point of any, I'm going back to UK, what are the implications and when am I planning to leave? And if I plan to leave, make sure that it's done either at the start of a new tax year or the tax year prior, but not enough days to trigger your UK residency. That requires going through the UK statutory residency test. And then, what changes do you need to undertake to become a UK fiscal resident? What assets do I have in Gibraltar? How do I make them UK tax compliant? What options are there? And and the recent changes in the autumn 2024 budget, when we shifted from a domicile based to a residency based regime, and there's something called FIGs. Matt, do you want to explain to our viewers what FIGs means?
Definitely, yeah. So we're not talking about the fruit. I think fig is a fruit, isn't it? We're talking about the foreign income and gains regime. So this was introduced in the budget you spoke about, Paul, where they made a lot of changes to the domicile region. So the FIGs works for people who've been out of the UK for over 10 years. And this applies to UK nationals and non-UK nationals as well. So, you're born in the UK, you moved, you spend, 11, 15 years out of the UK and you return. And when you return, you have 4 years where you can take advantage of the FIGs regime. And this is effectively where you can bring funds back to the UK and you're not paying any tax on those. So it's 4 years to take advantage of that. There are caveats that are involved in that. So, for example, if you do take advantage of the FIGs regime, you lose your personal allowance. So the 12,000, is it 12,577 now, is it? So you lose that as well. But you have these 4 years where you can kind of claim the FIGs, and it's a very kind of tax efficient way of kind of managing your money as you return to the UK as well. So I think one thing that's important that ties into this and ties into UK inheritance tax is that you don't necessarily want to bring all your money back to the UK with you. So just to mention UK inheritance tax, I think you mentioned, Paul, we moved from a domicile to a residency regime. So the rules are, you're in the UK, so you're out of the UK for 10 years, then you become non-UK tax resident, apart from on UK cited assets. So if I give you an example, you have someone who's been out of the UK for 20 years. They return to the UK, they're out of UK inheritance tax regime for 10 years, apart from on UK cited assets. So they have overseas investment account of £1 million. They keep that out of the UK. It's non-UK assets. They're back in the UK, but they've got 10 years where it won't apply. If they close it down and then invest on a UK platform or a UK provider, that immediately goes under UK inheritance tax. So there's a lot of planning to do. I think another thing that I think is very important, and we've done quite a few assessments of these recently, Paul, is to look at your income streams. Look at where you're drawing income from and see if you can get income from different sources so they're taxed in a different way. And I think one of those that can be really tax efficient from an income point of view on inheritance tax is a UK bond with a discounted gift trust. If you can explain that one briefly, Paul.
No, essentially, you take up a UK bond, which is a life insurance. That bond allows you to take 5% free of income tax in the UK for 20 years. It doesn't mean you have to take 5% every year, but essentially you can skip some years and then take more in another year. But so long as it's the equivalent of 5% a year, then there's no tax to pay during that 20-year period. And then you can settle that inside the discounted gift trust, which means that after, so essentially you're gifting the assets to your beneficiaries, but you can still enjoy the income that is derived from that investment in the structure. And what happens with a discounted gift trust is that it goes through actuarial advice, and based on your age and state of health, they immediately discount part of your investment to UK bond from your UK inheritance tax. And then the rest is on a 7-year, the gift rule, 7-year basis. So at the end of the 7 years, effectively all those assets are outside the UK estate. So if you've been more than 20 years outside the UK and decide to return, you've got a 10-year window in which you're not liable to UK IHT, correct?
Yes, correct.
You set up the UK bond, and within 7 years, the full amount you've invested into UK bond is outside your UK estate. And because this rule says that those assets don't come back into your estate until year 11, it means that effectively you've whitewashed them out of your estate for IHT.
Yeah.
So there's nice ways of structuring your investments. You can build up your ISAs, but FIGS is about being exempt to income tax and capital gains. Is that correct?
Yes, on those assets that
On
are
those
outside of
assets.
the UK. Yeah.
So
yeah.
you have a unique opportunity to plan ahead and to restructure everything. Each case is different, Matt. Each case is different. It depends whether you've been out 20, you've been out less, and then we tailor the advice based on their personal circumstances. But there is a possibility to do this properly. And as I said, Matt, and I repeat until I go blue in the face, you don't decide to move back to the UK from Gibraltar and then plan once you are back home. What do I do with my assets? What should I do? How do they make them tax efficient? That's not a smart way of moving back to UK. The moment you and your spouse or you make a decision to move back, at that point in time, you should really pick up the phone and call us and plan how we structure those pension savings and investments to maximize or to minimize tax in the UK. And I would add for the benefit of the viewers and the listeners, that we've got certain FCA permissions and regulation, beside being authorized, because Gibraltar has a special arrangement with the UK. So it is our bread and butter. We understand how to make this tax efficient in the UK. It's not as if we don't know. We trip into UK regularly to service clients.
I think that's a good point, actually, Paul, in the sense that we talk a lot about UK nationals moving out to Gibraltar, and we talk about that cross-border expertise. We understand and have regulations in both jurisdictions, but it's that understanding that's key. But also the same applies when you go back. You know, you speak to a UK advisor, they understand the UK, but they don't really understand that process of returning, and they certainly don't understand, you know, the setup of the assets that are in Gibraltar or wherever you're returning from. So, yeah, I think the underlying message is key. I think this is a message that we use for a lot, but it's true. Plan in advance, plan properly. There's a lot of tax savings that can be made, and structuring your assets to minimize income tax, inheritance tax, capital gains tax. So why wouldn't you do so? So if you're in that position, please pick up the phone, as Paul says, or drop us an email, and we'd be happy to have that kind of initial conversation with you. For anyone else, you know, keep subscribing, watching our videos. Feel free to like, share, and comment on those, and we'll be back with another video very shortly. Thank you.